Welcome to Market Catalyst. I'm Jared Blikre. We are 30 minutes into the U.S. trading day, and let's get now to the three market catalysts that we are watching this hour. First up, we're going to break down the latest on the trade front as the U.S. nears a deal with South Korea. Plus, oil prices slightly higher today. OPEC will be boosting output, but critically at a slower pace. Details to come and what it means for prices at the pump. And we're going to discuss the state of the consumer ahead of key inflation data this week. All that and more coming up on Market Catalyst. And let's now get a check of the markets. We got a mixed market. The Dow underwater, but just slightly, down about 0.2% here. I'll show you we were slightly in the green after the open, but not a big to-do here. The NASDAQ is where the action is. That is up about 0.75%. We have software flying high, and the S&P 500 a little bit lower, up about 0.2%. And you can see just kind of hovering around the highs of the day. And I want to get a quick check on small caps. Russell 2000 started out in the green. Now it is in the red, but in case you missed it, it is within about 2 to 3 percentage points of all-time highs, but those highs were 4 years ago, and that has definitely been a frustrating trade, the small cap trade, for investors over the last few years. And here's a 10-year T-note yield. It is down to 4.06%. This is intraday. I want to show you what's happening over the last month because this is really instructive here. It has crashed, and these are Fed rate cut expectations being priced into the short end of the curve. That's actually the 10-year T-note. This is the 13-week T-bill. This is what's happening on the short end of the curve. And you can see now the expectations for September rate cut, that happens next week, up to 1 and maybe 2, but that's not the likely case. And then the 30-year T-bond yield, that is down. That was almost at 5% at the beginning of last week. It is now down to 4.72%. So the entire yield curve has been shifting down. And I'll also give you a quick check on gold futures. Another record high there, 36.73. This is a 1-month chart, and you can see how they have just lifted off as yields have come down and those Fed rate cut expectations getting built into the market. Now let's take a look at the sector action. Only one sector is outperforming the S&P 500. That is XLK. That's up 84 basis points. Also in the green is consumer discretionary and communication services. So the three green there are the mega cap sectors. And what's not working today? Real estate and energy. Energy, really not a great trade last week either. And let's flip on over to the NASDAQ 100 to see some of the biggest movers. We have Nvidia up almost 1.75%. Broadcom taking on additional gains there after its earnings last week, and also that OpenAI partnership. That's up of almost 5%. Meta up 1.5%. And let's take a quick peek inside the software sector. I did say that was leading. We're going to be talking about Oracle earnings because we do have those on deck this week. That's up 2.5%, but we're also seeing some gains from IBM, ServiceNow, PanW, Snowflake, Take-Two. The list goes on. And not to be outdone here, I do want to show you the semiconductor trade. Lots of green on your screen here. Lam Research, we got a new partnership trade deal potentially with Korea. So we're going to be getting into those details as well. And trade is still a major focus for the Trump administration as an executive order signed Friday and now in effect modifies the scope of reciprocal tariffs. For more, we have Yahoo Finance Washington correspondent Ben Worschkel and Dan McCarthy. He is a former assistant U.S. trade representative for congressional affairs and principal at McCarthy Consulting. Ben, I'll start with you first. How does this new executive order change those reciprocal tariffs?
Yeah, so this order was sent to reporters at 7:30 on Friday and is already in effect as of midnight. And it offers, as you mentioned, a variety of adjustments. The headline adjustment here is gold. This was an issue, if you'll remember, about a month ago. There was a lot of turmoil in gold markets because it sort of seemed like gold could be subject to tariffs. This formalizes a Trump promise that that gold is not going to be included in that. There's a number of other goods, some that are added to the excluded list, some that are removed from it, that also are now in effect as well. There's also, interestingly, a list of goods that the Trump administration is now saying they could exclude per future negotiations. The sort of headline here are goods that the U.S. can't produce in enough quantity. As groups like the Yale Budget Lab have noted, the U.S. just doesn't produce that many bananas, but all these tariffs have produced a 10% tariff, or about a 9% tariff on foreign bananas coming in, even though there's not a big way to replace that domestically. So this is kind of a key signal from the Trump administration, both in the content here of kind of formalizing some of these goods, but also in the speed here. As I mentioned, this happened very quickly, and is a signal that this is the tariff authority that is under legal cloud right now. Two courts have ruled that this reciprocal tariff authority that Trump is exercising in this new order are illegal. The Supreme Court is set to weigh in there, but Trump is clearly sending a message here that he wants to kind of keep raising and lowering tariffs on specific goods, kind of on quick notice, no matter as this legal process plays out.
All right, Ben, stick around. And I want to bring Dan into the conversation. And let's stick with tariffs now. We have that big decision that the Supreme Court, they have to agree to take this potentially. And then over the weekend, Treasury Secretary Bessent was talking about the tariffs. And he said that the government, if the ruling is adverse to tariffs by the Supreme Court, that they'd have to give back potentially half of all the revenues collected. What are some of the details here, and what's your view of it?
Sure. Well, the Supreme Court's decision about whether or not to take up this case will be huge. Most expect that the Supreme Court will take it up. The Trump administration has asked for an expedited hearing process and review, looking for the Supreme Court to schedule arguments as early as November. It's unclear if the Supreme Court will grant that request, but in any event, you're seeing the Trump administration and the president feeling very bullish about their case, believing that ultimately the Supreme Court will rule that the tariffs are valid and can stay in place. But as we know, we've seen two lower courts rule the other way. So it's really an open question as to how the Supreme Court will rule. And of course, that has major implications. You mentioned the revenue issue. So the Trump administration has touted the significant revenue that the tariffs are bringing in. And that would be in jeopardy if the tariffs were struck down. But we also have trade framework agreements that have been announced by the administration, and those would be called into serious question if the Supreme Court were to rule against the administration as well. So major implications and a lot riding on the Supreme Court's case.
Yes, and you just mentioned those trade agreements, so I want to elaborate on that just for a second. We have a potential deal potentially with Seoul, with Korea. What are some of the sticking points here? Do you see this flying through in the near term?
So South Korea is looking at the agreement that was reached last week and announced with Japan as a roadmap. And one of the key issues is tariffs on cars that are imported from Korea. Japan was able to get a 15% rate equal to what the EU had received. That's a total of ceiling of 15%. So Korea is obviously a big exporter of cars to the United States, and they are very interested in getting an agreement that mirrors Japan because they don't want to be at a competitive disadvantage. So that is one of the issues that they're seeking to iron out. And then it's unclear how much the immigration raid that we saw last Friday at the Hyundai plant will play into these negotiations. It's possible that they could create a little bit of a roadblock, but also I think that Korea is really interested in wrapping this deal up. So it's possible that that could be just a speed bump on the way to an agreement. And then the other thing is it's really important here is the investment fund. So Korea had pledged $350 billion for things like shipbuilding, for things like battery manufacturing. We've seen some major announcements already in the shipbuilding space with Hanwha making a big announcement at the Philadelphia shipyard. But I think the details of how that's going to work is one of the issues that's under discussion as well.
And I want to ask you about what's called annual site licenses for this deal that we're talking about. Does this reduce potential supply chain risk? And if they have to be renewed annually, does this just kind of make some annual risk that the deal doesn't get approved for the next year? Is there any kind of risk along those lines?
There could be, yes. I mean, anything that requires a certain fixed review does create a little bit of uncertainty because there needs to be a negotiation around that. And as we've seen from this administration, the president does like to negotiate, and he likes to use deadlines and tools to incentivize what he would consider good behavior and sets up a deadline. And if that standard is not met in his view, you can see some changes the next go around.
One quick question. We got about half a minute left. U.S.-bound exports from China are now down about a third, 33% year over year. And it looks like the U.S. is heading toward a record trade surplus. Is this good for Americans?
Well, the China situation is very complex right now. We're seeing tariffs still in place both ways. That is definitely having an effect on a lot of both United States exporters who view China as a major market. That is definitely the case in the agricultural industry, where soybeans are definitely a big export that have been hurt by the tariffs that China has put on U.S. exports. Meanwhile, the tariffs on imports from China still remain high. So, I think it's less about, at this point, the trade deficit, and it's more about finding a way to reach an agreement that lowers the tariffs, and also, from the United States perspective, could result in some changes to China's unfair trade practices that have hurt United States manufacturing and businesses for a long period of time.
All right, a lot of moving parts there, and really appreciate your help breaking this down for us. Thank you, Ben and Dan.
Thank you.
And coming up, the outlook for energy markets after OPEC Plus agrees to hike oil production at a slower pace. That's next up on Market Catalyst. Oil rising after OPEC Plus members agree to raise oil output at a slower pace. Joining me now is Andy Lipow Oil Associates President. And let's start off with what this means for consumers at the pump. So more supply on the market means potentially lower prices, but there's usually a lag for feed through to the prices that consumers pay at the pump. What can we expect here?
Well, good morning, Jared, and thanks for having me. I think for the consumer, this is good news because OPEC Plus just finished with the restoration of 2.2 million barrels a day of voluntary production cuts. And here they're embarking on the restoration of another 1.66 million barrels a day. And this is going to continue to pressure oil prices. In fact, the Energy Information Administration is expecting WTI prices to drop to $58 a barrel by the fourth quarter of this year and into $50 a barrel by the first part of 2026. For the consumer, gasoline prices are now expected to drop 10 to 25 cents a gallon. And we have a real good possibility of seeing $3 a gallon as the national average in 2026.
You crack $3 a gallon. That will definitely get some headlines. I want to ask you about Drill Baby Drill. It's gathered a lot of headlines itself. How much of this is due to pressure from President Trump on OPEC Plus, and can we expect more production domestically, perhaps?
Well, I think there's a couple of things going on. I think Saudi Arabia is looking to recapture some market share, especially from members of OPEC Plus who have been overproducing. At the same time, they are heeding Trump's call to keep energy prices under control. But as far as U.S. producers, these lower oil prices are certainly bad news. And we've seen a series of layoffs being announced, the most recent being ConocoPhillips as well as Halliburton. So it's going to be very hard for the U.S. to continue a sustained increase in oil production. In fact, we think that it's going to plateau here in 2025. And probably decline by about 100,000 barrels a day in 2026.
I'm really glad that you mentioned those layoffs, because one of the things that we've been keeping track here at Yahoo Finance is the labor market writ large is pretty weak right now. We're just coming off a bad payrolls report, and this just kind of adds to the argument that lower oil prices, while good for the consumer, it does have some knock-on effects here. So maybe you could elaborate on the layoffs and if there's anything else that we should expect from lower oil prices.
Well, it certainly does have an impact in the oil patch, because it's not only when we think about ConocoPhillips or Halliburton, it's all the support services that go into the drilling, as well as we think about, those workers who are laid off. They were spending their paychecks on goods and services in their local communities. So when we think about West Texas or New Mexico and the impact of these layoffs, you can see it in many different forms.
Well, I want to ask you about Russia now, shifting gears just slightly, and the concept of dark oil, which is that when there's a ban, especially one placed on the West, on a producer, and it could be Russia, it could have been other countries in the past, a lot of times, or most of the time, those barrels of oil that are being produced still find a way through other channels to reach people who need it, countries that need it. I'm wondering if this is the case now, and if Russia were to be brought back into the fold with full approval of the West, would that really change the pricing situation?
Well, Russia has been utilizing the shadow fleet to evade sanctions, and they've been able to maintain their oil their oil exports, I should say, by significantly discounting the price And you're seeing India and China and Turkey and some smaller countries in the EU who have a waiver continue to purchase Russian oil. In fact, the European Union is expected to completely phase out Russian oil purchases by 2028. I think the biggest thing to look at for Russia is this Ukrainian drone strikes on production facilities and refiners that are impacting both production and the ability for Russia to export refined products like gasoline and diesel. And of course, that tends to tighten up the refined product markets around the world.
I want to close here with your bottom line case for Brent or WTI going into the end of the year and the early part of next year. Where do you think prices are going? You kind of touched on that in the beginning. And then what kind of blows up that base case, whether it's hurricanes or another OPEC plus twist?
Well, we're certainly seeing this additional supply that OPEC has been adding is really going a lot into storage, and eventually that storage fills up. So I think in the fourth quarter, you're going to see additional pressure come on oil prices. We should see WTI prices tick below $60 a barrel. Now, the flip side is, as you mentioned, on the hurricane season, it's been rather quiet in the Gulf of Mexico. There are no storms forecast to appear in the next 7 days, and we're kind of getting into the later season for the Gulf of Mexico. So we may have dodged a bullet as far as hurricanes impacting Gulf of Mexico oil production, which is nearing 2 million barrels a day. But we still have a few weeks to go through that. And of course, it's unclear whether OPEC Plus, they may halt their return of these voluntary restoration production cuts. They could, in fact, go the other way if oil prices get too low.
All right. Really appreciate a lot to get through there. Thank you, Andy.
Thank you for having me.
And all your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 1 hour into the trading day. You're seeing a mixed picture across the board here. You'll see that the Dow is off just around 40 points. The NASDAQ is up 0.6%, so definitely the leader here when it comes to the major indexes. Then the S&P 500 is trading up just slightly here, roughly 0.2%. Now, I want to take a look at some tech names within the NASDAQ. Nvidia in particular, you are seeing shares up around 1.6%, and this comes despite a price target decrease from Citi. Citi trimming its price target on Nvidia to $200 a share. That's down from the prior 210, but it is keeping its buy rating. The firm saying that competition from so-called XPUs, those are the chips being developed by the likes of Google, Meta, Amazon, that could shave about $12 billion off of Nvidia's 2026 GPU sales. Citi still sees Nvidia dominating with more than 85% market share, but does expect those XPUs to grow faster, especially as Google shifts to selling compute capacity to rivals like Meta and OpenAI. Now, even with this headwind, Citi does estimate that for 2025 and 2026, those years remain above consensus, helped by cloud and sovereign AI spending. The firm says that China could provide upside if shipments do restart, and that the next big catalyst for the stock will be CEO Jensen Huang's keynote at Nvidia's GTC conference on October 28th. So that's a bit of a ways away here, but DataTrek Research also pointed out that Nvidia is top of mind for investors, especially as it has not hit a record high in quite a few weeks. So some questions whether or not the AI trade is sustainable. I also want to look at Apple. Shares are down around 0.2%, and this comes ahead of its iPhone event. That is probably not going to move the needle too much when it comes to the stock, especially since investors have been hyper-focused on Apple trying to play catch-up in this AI race. Now, Bloomberg is reporting that Apple is working on a rebuilt version of Siri, so trying to have Siri turn into more of an answer engine like a chat GPT. Others on Wall Street, though, like Wedbush analyst Dan Ives, he says that Apple should be buying Perplexity, should be making bigger moves into the AI arms race. However, Apple just doesn't seem to be there at this point, and that's why it is one of the biggest laggards among the Magnificent Seven names so far this year. But we'll see what happens tomorrow during that iPhone event. But keep it right here on Yahoo Finance. We'll be tracking all of the market moves throughout the session.
Now time for some of today's trending tickers. We're going to be watching Alphabet, Dick's Sporting Goods, and Chewy. First up is Alphabet. Alphabet's Google was sued by advertising exchange PubMatic, which is seeking billions of dollars over its claim that the search giant has illegally monopolized the ad technology market. The lawsuit is a second by an advertising exchange to take aim at the tech giant since a federal judge ruled in April that Google had illegally monopolized two key technology markets, which are ad exchanges and tools used by websites to sell ad space, known as servers. And I'll also add that Alphabet hit a record high on the open today. Next up is Dick's Sporting Goods. The retailer has completed its acquisition of Foot Locker. The deal is expected to deliver between $100 million to $125 million in cost synergies in the medium term, primarily through procurement and direct sourcing efficiencies. Dick's reached a $2.4 billion deal to acquire Foot Locker earlier this year. While both chains rely heavily on selling sneakers, the acquisition brings together two companies with vastly different business models. Finally, Chewy. Mizuho upgrading the stock to outperform from neutral, citing valuations and expectations for another strong print. The upgrade by Mizuho analyst David Bellinger includes a price target increase to $50 from $44. Bellinger suggests the recent market activity has created a favorable entry point for investors. Chewy will report earnings later this week. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. And inflation continues to take a sizable bite out of consumers' wallets. And while their outlook is for more of the same, shoppers say they intend to continue to spend. And joining me now is Stephen Rogers. He is a Deloitte managing director. The firm took a snapshot of the state of the consumer with its well-being index. And why don't you just begin here with kind of explaining what it means, what the break-even point is, and just generally what some of your big top-level findings are.
Sure. It's great to be with you this morning. Well, consumers are feeling stuck in a higher cost economy. Even though inflation's cooled, and we've all seen that, consumers still expect gas and grocery prices to rise. For example, 7 in 10 consumers expect grocery prices to increase next month. That's up about 8% from last year. So those inflation expectations are starting to reshape behavior. Nearly 1 in 4 consumers leave the store feeling like they've bought less than they wanted to, right? But here's the paradox. Even though wallets feel squeezed, people are still intending to spend on personal care, clothing, home goods, etc. But much of that is being done on credit, right? So we're starting to see debt stress climbing the income ladder. More middle income, higher income households are carrying revolving balances, and while we're seeing some consumer resilience, that looks like a fragile resilience.
Well, I want to ask you then about grocery sticker shock, because 69%, and this is in your report, expect prices to rise next month. What are some of the trade down behaviors? Where would you expect to see those?
Absolutely, right? So really since COVID, we've seen a move towards private label. So people are moving to what they consider a more value for price product. And they're also looking for different retailers at the same time. And like I said, they're leaving the store with less than they want, so we're starting to see smaller baskets.
And I want to ask you about prices at the pump. You just mentioned gas prices a minute ago. Expectations remain elevated. We were just talking to an energy analyst a few minutes ago who said that gasoline prices could eventually dip below $3 per gallon, which would be kind of a headline grabber. Just wondering what you think.
Well, absolutely. Right now, more than half of consumers expect higher prices at the gas pump. And really the way they inform themselves about inflation are at the grocery store shelf and the gas pump. So if those prices do indeed come down, that's going to inform their expectations of price increases go forward, which hopefully will help them feel like they've got more jingle in their pocket.
And I want to ask you about the Consumer Price Index. We're going to get a read on that. It's a big one. It moves markets. What are you expecting to see in this report later this week, if anything?
Well, last report, basically we saw ourselves pretty much in the same place except for auto. Auto jumped a bit, right? And so I think what we're starting to see, again, inflation expectations, a consumer that is somewhat hesitant when it comes to durables, and I think we might see more of the same in this upcoming report.
And you mentioned spending on credit. Any specific industries where you're seeing more of that take place? And then what about the delinquency side? How concerned should we be about that?
Right. So we're seeing people use more forms of credit, right? The credit card, the buy now, pay later. This happens a lot in our retail industries, et cetera. As for defaults, right now they are on the rise, but I don't think they're at a level that banks are concerned.
And what about retail sales? That's another important report, a monthly one that we get each month, and don't focus on as much as the jobs report and inflation, but still important nevertheless to the U.S. economy. Any expectations for that?
Well, I hate to be a predictor, right? I don't really know, right, what consumers are doing, but at the bottom line is the consumers are resilient, but it's a fragile resilience right now. We're starting to see some cracks, right? They're still spending, but they're saving less, borrowing more, cutting back at the grocery store, right? So the new normal may be a potential slow grind consumer-led economy built on that adaptation and, not real exuberance.
All right, a couple of warning flags there, but really appreciate your insights and the details on that report. Thank you, Stephen.
Appreciate it. Take care.
And all your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Well, the American Dream in 2025 cost a whopping $5 million. This is $600,000 more than it did last year. It's according to an Investopedia study that estimates the lifetime cost of 8 major life categories commonly associated with achieving the American Dream. This includes retirement, home ownership, and healthcare, among other categories. Joining me now, I got Caleb Silver, editor-in-chief at Investopedia. Caleb, always great to see you. So the American Dream is going to cost $5 million. Let's start there. How do we define the American Dream? Walk us through it. Walk us through the criteria.
Yeah, great question. And everybody's dream actually has a different price tag. Yours is different than mine. But we looked at what people want, the wants, not the needs. And we actually surveyed our readers and beyond to find out what are the essentials for you that would make you consider yourself financially stable, that you finally made enough to be able to make those types of decisions. And you mentioned a lot of them. We're talking about retirement, healthcare, owning a home, potentially having 2 kids, sending them to college, having a new car every 10 years, having a pet. Pets get very expensive, my friend, marrying somebody off. So looking at an annual vacation, all these things priced in today's dollars, these things add up to about $5 million plus. The thing is, as you know, if you make the median income throughout your whole working life, 25 to 65, you get to around $2.3, $2.4 million depending. There's that gap there. Again, everybody's price tag is different, but these are the things that most people associate with, if I've done the work, if I worked hard, if I've saved, this is what I should be able to have. Again, the wants, not the needs.
Pets are expensive, by the way.
Absolutely.
I mean, my vet took a few teeth out of my dog. I didn't know she had teeth. Thousands. It's thousands, Caleb. $5 million. How does that compare versus last year? It went up 600,000?
Yeah, but we also added a little bit more around healthcare because we took healthcare at a base level in our initial surveys the last couple of years, but we know that people, by asking them through the survey, are thinking about premium healthcare in case something happened beyond the very basic. So that's very important to American families, and they said as much, and that is about $414,000 over a lifetime. Again, these are lifetime costs, adult lifetime costs, and you look at retirement, $1.6 million. That would give you around $67,000 to $68,000 a year for 20 years after the retirement age of 65. Again, for some people, not nearly enough. For some people, too much. But it all depends on what it costs to be the you that you want to be. And that's how we boiled this down.
The $5 million, how does that compare to sort of the lifetime earnings of most Americans?
Yeah, it's about 2 to 3 million higher than most people are going to earn, which is why we need to invest. How do you fill the gap? You fill the gap through investing, through saving, through owning assets. And if you're not investing or you don't have asset ownership, it's very hard to cross that threshold into the feeling wealthy, that sense of I can make decisions based on what I need to do for what's best for my family without worrying too much about money.
What kind of education do people typically need to hit that $5 million bogey?
Yeah, well, education usually helps, but we've seen some softness for people that have college degrees, but it's not just about that. It's about increasing your income over time and then paying your future self through the investing part, which is why we stress it so much and which is why that number is the biggest one out there next to home ownership. Now, not everybody wants to own a home, not everybody can own a home, but if that is part of your plan, you better budget $900,000 at least over, again, the lifetime of owning that home, because the median price is around $415,000, in different parts of the country. country. It's a lot more than that. Again, these are the base levels of this, and your dream, the important thing is to find your own number and work your way back from that.
Does everybody, Caleb, typically have to be working in the house to hit that dream? Is it a dual income?
Household income. And that households, can be 2 to 3 plus people. We're also talking about having a couple of kids and then eventually sending them to college. Kids from the toddler age up until you send them to college, through college, that can cost quite a bit when you think about camp and you think about childcare and all the things that go with it. Again, not everybody wants these things, but in our surveys, most people identified with these categories, and then I got to put a price tag in today's dollars, given inflation, for a lot of the things that have gone up more than inflation: housing prices, college tuition, et cetera.
Now, here we're talking about national averages, Caleb, right? But the cost would, of course, vary depending on where I live in the country.
Absolutely. If you want to do this up in Greenwich, Connecticut, you're going to need to add some commas onto that $5 million. If you want to do this in other parts of the country, it's more affordable. If you want to send your kids to community college or state school, or maybe you get a scholarship or financial aid, it looks different. The reason we do this is because everybody's talking about the loss of the American dream, or lamenting it, or saying it's out of reach. Well, know what that reach is by determining what your number is. Again, what does it cost to be the you want to be? Work your way back from that. It might not be 5 million, it might be lower, it might be higher.
Finally, before I let you go, I always like to get a quick pulse check from you. The Investopedia audience, all those Investopedia fans, just how are they feeling about the markets right now?
The smartest.
Cautious, constructive, what do they think?
Yeah, these are the educated investors, cautious and constructive, enjoying the all-time highs, but worried, and they're seeing...
What's on the worry list?
The worry list is the economy right now and the impact that we really haven't felt, but we're starting to feel about tariffs, and then what happens when the economy and the stock market, which are very different, really head the other direction very quickly. And I feel like we're at that point where you're kind of feeling the pull in two different directions here. This bubble up of asset prices, good for the shareholder class, good for asset owners, but the real economy, as we know through the jobs report and other anecdotal data, that is souring. That said, they're positive, they stay smart, and on behalf of the Investopedia readers, I'm going to give you a pair of Investopedia's famous socks, because
that comes with the merch.
These will make you a smarter investor.
Fantastic. Thank you, my friend. Appreciate it.
You got it.
Startup Interlude signed a contract with the U.S. Department of Energy for plans to mine helium-3 on the surface of the moon, all before the company has executed its first journey into space, which it aims to complete by the end of this year. It's part of a side of the space economy that my next guest says is growing in recent years. And here with more on some of the emerging ways to play the emerging side of the space race is Chad Anderson. He is a Space Capital founder and CEO and author of The Space Economy. Chad, great to have you here. We're going to get to mining helium-3 on the moon in a second, but first I want to ask you about Elon Musk. We had some really big news last week about a pay package at Tesla. Anytime that's kind of front and centered, it suggests that he's going to be spending a lot more time over at Tesla, maybe to the detriment of SpaceX. How big is SpaceX in the industry, and how does it kind of affect your role as a VC allocator of funds?
So, I mean, in the space economy, SpaceX is the apex player. The U.S. Space program has become completely dependent on the company over the past 10 years. And the reason for that is because the company does things better, faster, cheaper than anyone else, right? I mean, there was a lot of incumbents before SpaceX that had gotten sort of fat and happy. And SpaceX came in and shook things up and did things in a different way. So they have certainly earned their place at the top of the food chain in the space economy. And, I mean, Elon Musk has been involved in many companies since the beginning, and I don't think that that's going to change.
Yes. And now I want to ask you about helium-3. Kind of blows my mind that we're talking about allocating resources to mine stuff on the moon, no matter what it is. I mean, it could be helium, it could be anything. How realistic is this? Is there a time frame, realistically, that we can wrap our heads around this?
Yeah, so helium-3 has been the holy grail of lunar resources for decades, and it's really been hyped that way. And I think the idea is that the moon will be sort of Saudi Arabia for the 21st century, where it's exporting clean fusion fuel to power the world.
And that's what it is. It's fuel, because you can then use that to parlay in a journey to Mars or other things. Like, where does that take us?
Well, the idea, I think, I mean, the numbers that they're talking about in terms of market, I think what they're talking about doing is extracting it and using it on the moon, but also bringing it back to Earth. So, I mean, the challenge is that there's a long way between here and there, right? There's no fusion reactors. This is a potential fuel. There's no fusion reactors that are using fuel today. So this is kind of this is really interesting because it's sort of, we're seeing private capital test the boundaries of the space economy and what's possible. But at the same time, it is sort of a moonshot on top of a moonshot.
No pun intended, yeah. Testing the boundaries, we've seen that play out in the investment market before, kind of a function of liquidity. I want to ask you about the Trump administration, who has arguably been vocally supportive of U.S. space endeavors. And he says he's moving the U.S. Space Command headquarters from Colorado Springs to Huntsville. What are the ramifications of that? Does it change some of the players? Does it mean some people will get favored status over others? Any changes there?
Well, no real changes in the immediate term. It's going to take some time for that to play out, right? So the Biden administration moved it to Colorado based on readiness, is because they had the facilities there already built out. So they can move it to Alabama, but it's going to take some time to build out those facilities and get it ready. So in the next few years, there's not going to be any practical impact, although there's going to be probably more flights by incumbent space companies going to both locations.
All right, a lot of the discussion so far has admittedly been theoretical, and we're talking about the far future sometimes. What can investors invest in right now in terms of space?
Yeah, so like lunar resources, for example, is one piece of what we call emerging industries. That's really like 3% of what's going on here. And it includes other things like commercial space stations, like logistics is another area in the emerging industries that's really interesting, which is space situational awareness, space traffic management. We're launching so many more thousands and thousands, hundreds of thousands of satellites. How are we making sure that they all have safe orbits to operate in and they're not running into each other, right? And also companies like Impulse Space that are doing propulsion, which is allowing the Trump administration to do more Space Force activities like rendezvous proximity ops, basically being able to have your satellite go, change its orbital inclination, change its altitude, move around and do different dynamic maneuvers as we build up the Space Force and as we think about space as a contested domain.
I want to ask you about some of the larger players that we think of in aerospace and defense, like maybe Boeing, Lockheed Martin, Raytheon. How are these players positioned well in the space race?
Yeah, so I mean, everything that's going on today from a private capital, private markets perspective is really underpinned by SpaceX and their ability a little over a decade ago to bring prices down, bring costs down, bring transparency to pricing and to the market for the first time. So the incumbents were, like I said, they'd gotten a little comfortable.
Little too fat and happy.
Then SpaceX shook things up a bit, right? So they are working to get back into this. There's a lot of opportunities for these incumbents are looking for, they've all set up corporate venture capital funds to invest in early stage companies to get more involved in them. We're seeing more teaming agreements and partnership agreements to go after big government contracts. But look, the Golden Dome Initiative is a massive $175 billion White House initiative for defense, and space companies are going to play a key role in that. From startup companies to the big incumbents, everyone's going after that pot of money.
All right, you got your work cut out for you, I know. Thank you so much for joining us here today, Chad.
Thank you.
And coming up, we got full market coverage ahead in the second hour of Market Catalyst. Do not go anywhere. Coming up on this hour of Market Catalyst, first up, earnings season coming to a close. We're going to preview what's to come and what it means for the tech trade. Plus, Robinhood joining the S&P 500 at its next rebalancing. We're going to discuss what its inclusion means for the stock, and we'll hone in on the Fed, inflation, and the state of the labor market with Goldman Sachs chief economist Jan Hatzius. 90 minutes into the start of the trading day, I'm Jared Blikre, and let's get a quick check of the markets here. We've seen a mixed day so far, but everything in the green right now, I believe, and you can see the Dow there up about 70 points, nothing too big, and the S&P 500 up 1/3%, and the show stealer, the showstopper, is the NASDAQ Composite hitting a record intraday high, and it is up 0.75%. And investors are fully pricing in a Fed rate cut next week after weaker than expected jobs data. Joining me now, Yahoo Finance Fed correspondent Jennifer Schonberger and Bill Adams, who's a Comerica Bank chief economist. Jennifer, let's start with you. Treasury Secretary Scott Bessent wrote an op-ed in the Wall Street Journal over the weekend saying that the Fed must change course. What are the details?
That's right, Jared. In a Wall Street Journal editorial, Secretary Scott Bessent criticized the Federal Reserve for what he called mission creep. He said the central bank needs to reestablish its credibility as an independent institution and called for an open, honest, nonpartisan review. Bessent, who said the Fed has devolved into a monetary policy experiment, wrote in that op-ed, quote, overuse of non-standard policies, mission creep, and institutional bloat threaten the central bank's independence. The Fed must change course. Its standard toolkit has become too complex to manage with uncertain theoretical underpinnings. Simple and measurable tools aimed at a narrow mandate are the clearest way to deliver better outcomes and safeguard central bank independence over time. Now, the secretary also pointed to the Federal Reserve's use of its balance sheet and purchase of treasuries and bonds to steer capital through this economy, something he says should really be in the jurisdiction of markets and elected officials.
Well, Bill, I want to bring you in here. We were just listening to some comments about that WSJ editorial from Bessent over the weekend. He's talking about the Fed's toolkit maybe being a little bit outdated. And we know that the Fed itself is data dependent. Is it maybe a little bit? Is that why there are all these calls for the Fed to cut rates right now and saying that it's a little bit too late to the rate cutting party?
The political pressure on the Fed is nothing new. And really, if you look back to how the Fed was established, the setup of the central bank to be independent of direct influence from elected officials is kind of anticipating the dynamic that we're in right now. I think with the weaker than expected August jobs report, and then also other jobs data that we're expecting out this week that are likely to show downward revisions to job growth leading into 2025, I think the case for rate cuts at the decision later this month is likely to be pretty straightforward. And I expect some of the pressure on the Fed to quiet down as they begin to start reducing interest rates.
Well, let me ask you about that BLS revision. You just kind of hinted at that. What are some of the details? This is a benchmark revision, and we already, as we've been talking about, have seen weak labor data. What will this reveal about the U.S. economy and the existing labor stat?
The monthly jobs report draws on a survey that receives responses from about 50,000 employers, establishments is what they're technically called. And this revision is going to include more detailed data that really covers 11 million workplaces. And so much more detailed data that will also provide better measurement of how many jobs are created at newly opening businesses and how many jobs are lost at closing businesses, which the BLS has to estimate month to month with statistical tools. So that those more detailed data will likely show that job growth in the year through March of this year, so that's March 2024 through March 2025, was about 775,000 less in aggregate than the current data in hand shows. So that's a big downward revision if we see something in that ballpark. But recall that this is fairly dated data. This is saying what the economy's momentum was coming into 2025 and says less about where the economy is today than that jobs report, which we saw last Friday.
And Jen, we are expecting CPI data this week. It's a pretty big one. The Fed has its dual mandates on the inflation side, also the workers' side. So what are expectations for CPI?
Yeah, that's right, Jared. We're expecting CPI on the headline to pick up a little bit, come in a little bit hotter at 2.9% versus 2.7% in the prior month. That core measure, if you will, which excludes those volatile food and energy prices, which is the measure that the Fed really likes to look at inflation on, expected to hold steady at 3.1%. But we're really a full percentage point above the Fed's 2% target at this point. And you weigh that with the weaker jobs report that we had for the month of August and the revisions that we saw into negative territory for the month of June. And we've really seen a trend of slowing job growth for the past 3 months. And the guests mentioned we're going to see those benchmark revisions from the beginning of the year. And Fed Governor Waller has said that he expects that we could see job growth turn negative. So when the Fed is going to look at both sides of its dual mandate and assess, well, we've got a little bit of stickier inflation, but we've got a weakening job market, I do believe that we're going to steer towards that weakening job market and that they will cut by 25 basis points. I think the question becomes, what does the path look forward for the rest of this year and into 2026? And typically when the Fed begins to cut, it's not going to be one and done. They're going to initiate a series of cuts. The question is how big and how fast. If we continue to see inflation around this 3% level and the job market kind of weaker but not going negative, then maybe they go a little bit more slowly and smaller increments. If we see the job market start to deteriorate faster, really snowball, and that's something that can happen quickly and something the Fed wants to prevent, then we're going to see larger cuts more quickly.
And Bill, let me just throw this to you. Expectations for the Fed rate cut. This will be the final question here. We got a minute left. September rate cut kind of expected by the market. 50 basis points was on the agenda, at least in terms of some of the bond market pricing in that I've seen. What do you expect between now and the end of the year?
I think Jen nailed it about how it's really dependent on the labor market right now. Comerica's forecast is for the unemployment rate to tick back down to 4.2% and hold there through the end of the year. And I think if we see that, the Fed could skip an interest rate change at the October decision and then make another cut at the December decision. So our current forecast at Comerica is for a cumulative 0.5% in cuts between where we stand today and December 31st.
All right. Really appreciate those insights, Bill. And thank you, Jennifer, as well. All your markets action ahead. Stay tuned.
Thanks,
You're
Brad.
watching Market Catalyst. Oracle set to report fiscal first quarter earnings on Tuesday. Investors expecting strong results after the software company issued upbeat guidance last quarter. And joining me now is Daniel Morgan, Synovus Vice President and Senior Portfolio Manager. So let's start at the top. What are you?
Hi, Jared.
Hi there. What are you expecting to hear from Oracle?
Well, Jared, I think, coming into this first quarter of 26 print, obviously the street's going to be looking at, top and bottom line growth in terms of did they exceed estimates in revenues and earnings. But if we kind of drill down to those, we're really looking for further evidence that Oracle is making this transition into the cloud. A lot of people are going to be focused on their total cloud revenue growth, which should be about 28%. And then the key unit, Oracle Cloud Infrastructure, abbreviated OCI, we're looking for 53% growth there. So everyone's going to be looking at, Jared, is Larry Ellison continue to make huge strides in the data center space, and how are they stacking up against legacy competitors like AWS, Azure, and GCP? So far they've been doing a good job making that transition.
Well, Ed, maybe we can back up here for a second. I remember Oracle as one of the huge players 25 years ago in the dot-com boom. You had Oracle, Cisco, Microsoft, and they've transformed quite a bit. They've had to. You just mentioned the cloud as a necessity here. How does Oracle now fit into the AI trade?
Well, I think it would have to be from this huge demand they're getting for data center. They came out on the last quarter, their fourth quarter, and they said they're going to spend about $25 billion in CapEx to continue to build out roughly about 23 data centers. So they would be a company that would obviously be facilitating the use of AI within the data center. They also, as you mentioned, Jared, Oracle's been around forever, right? They were a relational database company. Then they got into enterprise resource planning, which they still are involved with. And then they migrated finally into software as a service, and now they're in the cloud. So within that huge installation base that they have, which is about 400,000 customers, they obviously have products and middle software products that facilitate ERP and database that are also AI focused. So I think that's how we have to kind of position Oracle right now as an AI trade. I think it's a little bit different than, let's say, an Nvidia or a Broadcom or an AMD, because they're involved more on the software side.
Yeah, really helpful there. I want to talk about the multi-cloud here, and hopefully in plain English, we have, as you've been saying, Oracle has tie-ups with some of big cloud here, and they're expanding that market. How does this fit into their business when you consider that they also have Oracle Cloud Infrastructure, or OCI? Does it cannibalize that business?
I don't think so, Jared. I mean, they've come out and been pretty, forthright in terms of their goal to expand this multi-cloud model. They put out a picture of the globe, and they have multi-cloud sites all over, and they're continuing to build it out. So I don't view the multi-cloud strategy as something that could cannibalize, let's say, OCI. I think it's something that is complementative, in terms of their ability to go into, let's say, a CIO's office and kind of pitch this broad-based capabilities that they have, going all the way to the database, ERP, OCI, and then multi-cloud. So they definitely have a lot going on in terms of things that they can offer.
And speaking of a lot of things going on, they are also in the healthcare space, and that's thanks to the Cerner acquisition, which took place in 2022. What's the story there? How does this fit into earnings? What are you looking at?
Well, Jared, that acquisition initially was kind of people like, oh, that's interesting. Oracle's getting into the healthcare area.
Right.
But obviously, healthcare is a very steady type of business. It's not as cyclical as some other areas, and it has helped boost their growth. It has facilitated, an increase in revenues as they kind of move the Cerner revenues on top. So I think it's been a positive. It's just, again, expanding that capability of things that they're able to offer. So, that deal was done a couple years ago, and it has been, I think, met with, an applause up to this point. But they've kind of moved on from Cerner, and now they're getting into, the overall huge cloud side of the business.
And expectations are riding high. So just thinking about these earnings announcements, last week we had a disappointment from Salesforce. What are the odds of something like that panning out?
Yeah, if you look at the software space, Jared, it's been really tough, right? You look at Snowflake, you look at Salesforce. A lot of these companies have not really been performing as well as you would like. Microsoft has been performing, but I think Oracle's in a little bit of a different area just because they are making this huge migration over into the database area. If you think of Salesforce, they're really more software as a service, right? That's their niche. Mm-hmm. And I believe that Oracle is more focused on infrastructure as a service. So I think that gives them a little bit of a leg up. And, we're looking for a great print out of them. Their backlog on the last quarter was $138 billion. It's expected to be $149 billion on this upcoming first quarter. So we're looking for big things out of Oracle. And, Jared, sounds like you've been in this for a while, like me. I wrote a piece that talked about how I thought on that fourth quarter print that it might have been a watershed moment for Oracle, kind of like Microsoft, 7 or 8 years ago when they finally broke out of enterprise and got into cloud. So we'll see if that comes to fruition.
That could be huge, and we will break those results right here. Really, thanks for all your insights there. Great talking with you, Daniel. All your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. You're seeing green across your screen here. Earlier in the session, it was a mixed picture, but we have now flipped into positive territory for all three of the major indexes. The Dow is up around 80 points. The NASDAQ up roughly 0.7%. And the S&P is up about 0.3%. Now, I also want to take a look at the Russell 2000, the small cap index. We are up just slightly today, but if we take a look over the past month, we have rallied about 8%. And this comes on the heels of more expectations for Fed rate cuts. Markets are debating between 25 basis points in just a few weeks or a 50 basis point cut. Inflation data out this week will help the Fed determine which direction it will take. But if you compare this gain of the Russell 2000 to the month-over-month gain of the S&P 500, you'll see that that small cap index has consistently been outperforming. Now, a few on Wall Street have said that although signs of broadening are showing up in the market, like the rally that we've seen in small caps, there are still concentration risks. Apollo chief economist Torsten Slot called that out in a note this morning, saying that the market has not been this concentrated since the dot-com bubble in the early 2000s. So something to keep an eye on as we continue to track the sustainability of this rally. But speaking of rate cuts, if you take a look at yields, they just continue to move lower. The 10-year yield down around 3 basis points, trading just above 4%. And the 30-year yield is down 6 basis points, hovering at that 4.7% level. And it wasn't too long ago that we were worried that 30-year yields were approaching that critical 5% threshold. Doesn't seem to be a concern at this point. And while yields are falling, we are seeing gold move higher, continuing to hover at those record highs. We are trading just under $3,700 an ounce. And keep it right here on Yahoo Finance. We'll be tracking all of the market moves throughout the day's session.
Now time for some of today's trending tickers. We are watching Nvidia, PNC, and Baidu. First up, Nvidia, seeing a price target cut at Citi. The new target is $200 per share. And joining us with more is Yahoo Finance senior reporter Ali Canal. Great to see you here. So talk to us about this stock, Nvidia. It's been a few weeks since it's had a record high, and sometimes that makes investors a little bit nervous.
Yes, and Data Track Research called that out in a note this morning, saying that Nvidia and Microsoft, two names that have really been leading this AI-driven rally, they haven't seen those record highs in a few weeks. So is the AI trade on wobbly footing? That has been some of the commentary. And you saw Citi cutting that price target from the prior $210 a share now to $200. But they did still keep their buy rating. The firm saying that competition from so-called XPUs, those are chips being developed by the likes of Google, Meta, Amazon, that could shave about $12 billion off of Nvidia's 2026 GPU sales. Now, Citi still sees Nvidia dominating this market with more than 85% market share, but does expect those XPUs to grow over time, especially as Google shifts to selling compute capacity to rivals like Meta and OpenAI. Citi did call out some catalysts ahead, such as China, if those sales resume, although they did say the next big catalyst for the stock will be CEO Jensen Huang's keynote at Nvidia's GTC conference in October. So October 28th is when that GTC conference will be. So still have a few weeks to go there. So we'll see if we can get a record high in between then and now, Jared. But a little less conviction out there on the street when it comes to the pricing of Nvidia shares.
I hear you. And next up, we got to talk about PNC, which is agreeing to acquire First Bank in a deal valued at $4.1 billion. The regional bank looking to expand its footprint through the deal. And Ali, this is a stock that is up really nicely off of those 2023 lows, but I'm noticing that it's having a little bit of difficulty kind of punching through those late 2021, early 2022 highs, but that's just the stock movement.
Right, and financials as a whole, XLF, that has really been outperforming over the past year. Regionals in particular, on the back of those expected rate cuts. Now, PNC, they want to have a more solid footprint in the Rocky Mountain region, and this deal certainly gives them that. 120 branches, $26.7 billion in assets from First Bank, and it makes it the largest bank in Denver. Now, the acquisition also adds more than 70 branches in Arizona and boosts PNC's total assets to roughly $575 billion. PNC has been on this buying streak in recent years, including its $11.6 billion purchase of BBVA's U.S. operations. And it does put it closer in size to rivals like Capital One, like U.S. Bank. Of course, it lags some of those bigger banks that we often talk about, like Bank of America and Wells Fargo, along with JP Morgan. But you are seeing shares off just slightly today, down about 0.5%. But like you were saying, Jared, we have seen a decent run up in recent months.
All right. And finally, we got to talk about Baidu. The shares are seeing their biggest jump in years, or at least 1 year, as optimism in its AI efforts and robotaxis grows following an offering of new senior notes. And so robotaxis grabs a lot of headlines, Ali, and we're seeing a nice pop today. But Baidu, like a lot of Chinese stocks, has just been really beaten down over the last few years, and everybody's wondering where the next stimulus is coming from. What about this latest news?
Right. Well, because of the recovery that we've been seeing in the Chinese economy and therefore the Chinese stock market, that is lifting some of these names that have been under pressure. Now, Baidu shares jumped nearly 13% in Hong Kong. Like you were saying, Jared, this was their biggest gain in a year, and it was fueled around a lot of that excitement around artificial intelligence, robotaxi technology that tends to get investors really excited when they think about the future, not just for a company like Baidu, but even more U.S. names like a Tesla, for example. Now, Now, the pop does come as Baidu plans to increase yen-dominated senior notes and prepares to unveil an upgrade to its reasoning AI models at a developer conference in Beijing tomorrow. Now, analysts are saying that the rally may reflect market exuberance more than fundamentals, especially considering how bullish some investors have been when it comes to putting their dollars overseas as opposed to parking it here in the U.S. Now, Goldman Sachs pointed out that Baidu is a global leader in driverless commercial rides with its Apollo unit among the top 2 players worldwide. So a bit of a mixed bag when we look across Wall Street and whether or not they think this is just over exuberance or if Baidu really does have the fundamentals to support these gains here. But again, something that we'll be tracking as we continue to watch that Chinese stock market and the Chinese consumer very closely as well.
You bet. And you at home can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. And lots of news in the crypto sector. First, Robinhood rallying early in today's session. Investors getting in on the trading app, betting that it's going to join the S&P 500 in just a little bit, a couple weeks here. Plus, Gemini, the crypto exchange founded by Cameron and Tyler Winklevoss, the Winklevi twins, is expected to go public this week. And for a look at how much room crypto stocks could have to run, let's bring in Andrew Forsen, DeFi Technologies president. And thank you, Andrew. Let's talk about Gemini first. This could be an exciting IPO. Tons of hype over crypto this year, and a lot of it's deserved because we have this crypto-friendly administration. What about this particular offering? What do you see there?
Well, I think it's an incredible offering, in large part because anytime you are having an exchange, you're promoting liquidity within the industry. And I think what that liquidity means is people have further access to the particular financial instruments. I also think it's very interesting the growth of these digital asset underlying companies like a Gemini, like a DeFi Technologies, in terms of their exposure in the capital markets. That's really important because we're now being able to see a real intersection between traditional capital markets having broader acceptance for digital assets, which is something our own firm specializes in, DeFi Tech.
And that's great because it kind of leads to my next question here. Next line of thought is on S&P 500 taking on Robinhood. And this is, of course, an exchange. You can trade not only stocks, but also crypto. And Robinhood was kind of identified with the meme trade just a few years ago. But there are other changes in the S&P 500. There were some thoughts that it might be MicroStrategy that gets the nod. That was not the case. I'm just wondering what you think about Hood getting in and MicroStrategy not making it this particular round.
You know, I think that is a great question. And it really goes to show that those entities that have a very diversified exposure to digital assets, like a Robinhood, does have diversified exposure because it facilitates access to a broad array of instruments. The risk profile associated with entities like that tends to be lower. And we are going to find that there's going to be a migration, in my view, from the single asset focused entities to more entities that have a broad-based exposure to digital asset underlying, whilst also facilitating capital market access like DeFi Technologies.
And I want to ask you about stablecoins because those are set to become mainstream thanks to the Genius Act. And I don't think everyday Americans have quite wrapped their heads around not only what stablecoins are, but especially their future and how they're now tied to the treasury market, or at least they will be in the future. How do you see this playing out?
I think you've hit the nail on the head when you address the importance of stablecoins. Stablecoins, in my view, have long been the killer app of blockchain. And for the general public, stablecoins are basically on-chain or digital representations of fiat money. But why it's particularly interesting is these instruments are backed by the treasuries of respective countries. The most popular stablecoins in the world tend to be the US dollar denominated stablecoins like USDC backed by Circle and USDT backed by Tether. But it allows for very, very fast settlement and movement of money. And I think you'll find that those companies that have aggressive positions in developing these stable coins, these are going to be the finance companies to watch in the future.
Yeah, I agree there. And let's talk about DC for a second, because this has admittedly been a very crypto-friendly administration, and it's still the first year. Are people looking ahead to perhaps the next administration coming in, which might not be as crypto-friendly? I'm just thinking about the potential volatility here. All the initiatives being rolled out. What's the potential for things to shift in the future?
Yeah, crypto is not just an asset class. It's actually such a fundamental technology that the likelihood of it ceasing to exist is incredibly small. The advantages and benefits of these digital asset technologies, we're just beginning to see what they can do. So I think no matter what administration comes in, whether it's friendly or not friendly, the amount of growth in this industry is A, unstoppable, and B, it's going to be exponential into the future, because the strength of the technology is it's just unmistakably important.
All right, and we're gonna have to leave it there. Really appreciate all your crypto insights and DeFi as well. Thank you, Andrew.
Thank you so much.
And all your markets action is ahead. Stay tuned. You're watching Market Catalyst. It's an AI-dominated world now, and Nvidia's chips are leading the way, yet most people still know the company for its gaming chips. On today's Stocks in Translation, we're going to show you how the money engine at the world's largest company by market cap has shifted and why it matters for investors. First, a quick visual on Nvidia's data center, which is basically its AI business versus its gaming business. First, let's focus on the left, which covers the data center. It's a warehouse of network servers that run apps and AI, and its products are AI chips and systems for the cloud. Who's buying them? Amazon, Microsoft, Google, plus other large tech companies. They're scooping them up so they can offer AI services for businesses and even to the public sometimes at scale. On the right side, we have gaming. Think GeForce PC graphics and Nintendo console chips. And everyone from PC gamers to PC makers, both retail and online, are still paying up for these premium graphics chips. Fueling the buying spree are big game releases and new launches of the gaming chips themselves. And now let's show how big each of these two markets really are, as of Nvidia's last quarter ending in late July. That top bar here shows Nvidia's revenue or sales for its data center business, $41 to $42 billion. And you're going to quickly notice how much smaller that bar underneath is, just $4 billion. That's the gaming business, which is only a tenth of the AI business, not a subtle difference at all. And how did we get here? AI native companies, those built around AI from day one, they are scaling real revenue exponentially. Listen to Jensen tell it.
If you look at the AI native companies, last year they did $2 billion altogether. The first year of AI revenues. The second year of AI revenues, $20 billion, tenfold increase in 1 year.
Now let's take another look at data center sales versus gaming, but over time, going back to 2014. Notice how both lines track each other for years until data center in white suddenly rockets higher while gaming continues on roughly sideways. And by the way, those two lines go from solid to dotted at the right side of the chart, which represents estimates of future sales. What's clear is the gap between the two segments is only expected to grow wider as the pace of data center growth holds steady. And a quick aside, that's probably the number one risk to this stock. If data center growth slows down instead of keeping at its current pace. And here's the twist. AI is also boosting Nvidia's gaming segment. And let's listen to Jensen again.
And now what's amazing is AI is coming back to revolutionize GeForce for gaming. And this last quarter, I think we had a record quarter for gaming between GeForce and Nintendo Switch.
Think of Nvidia as AI infrastructure first and gaming second. And the feedback loop from AI makes gaming that much better. For investors, that means the biggest driver is still the data center engine, while gaming benefits from new GPUs and also hit titles. Now here's what to watch next for investors. For the data center, you got to keep tabs on the industry-wide spend on cloud AI, as well as a backlog. That's in addition to AI chip shipments and supply trying to keep up with that demand. And under gaming, watch out for new hit game releases, along with new gaming chip launches, along with pricing. If cloud budgets keep expanding and shipments stay on schedule, the data center story has room to run. And if rivals press on price or if supply gets tight, watch those margins in Nvidia. So in gaming, a strong holiday lineup or a new GPU cycle could easily give the franchise an extra lift. And bottom line, Nvidia's reputation was built on gaming, but the story today is the AI factory. The charts show it, the orders confirm it, and the roadmap extends it. Tune into episodes of Stocks in Translation podcast for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's websites or wherever you find your podcasts. Welcome back. Let's get a quick check of the market here on the Wi-Fi Interactive. We have a positive market in all three of the majors. Dow Jones Industrial Average is up 25 points. Not a lot, but I think investors will take that on a Monday. And you can see we've been in the red, we've been in the green, and well off of those highs now, approaching the unchanged line. And the story of the day has been the NASDAQ, still holding on to gains of 62 basis points, or about 0.6%. Meanwhile, the S&P 500 up 0.25%, and also off of its highs there. Then I want to show you what's happening with the small caps. We got the Russell 2000, a broader gauge that includes unprofitable companies. That is up just barely 11 basis points. And here's the S&P 600. That is also a small cap index that requires companies to be profitable to gain entry. And that has been negative all day long, down about 0.5% right now. And we got to check out what's going on in the bond market. Here's a 10-year T-note yield. It has been heading south for a number of weeks, and now it is approaching 4%, up or down 4 basis points today to 4.05%. And then on the longer side, the 30-year Treasury bond, that yield is down to 4.71%, down another 7 basis points today. That is pretty big inside the bond market. And here's the U.S. dollar index. That is down about 0.2% as well. We've also been tracking gold futures all day. Those are up 0.7%. Current price, $36.7980. That is a record high for gold. And then just taking a quick look at silver futures, those are up to $42, recently reaching 14-year highs. And now let's get a check on the sector action. Inside the S&P 500, the large cap sector is winning today. Tech is number one. That is up 0.9%. Followed by consumer discretionary. Then also green, we got communication services and industrials. To the downside though, we got a few off more than 1%. That would be real estate and utilities. And then just taking a look inside the NASDAQ 100, a lot more green than red. The NASDAQ composite hit a record intraday high, also set for a record close today, but not the case with the NASDAQ 100. Nvidia up 1.5%, Microsoft up 1%, so is Meta, Amazon approaching 2%, and Broadcom coming off a monster week last week after earnings and that OpenAI news, that is up 3.69%. And leading to the downside, it looks like we have T-Mobile, that is down 3%, and not too many others in the red, down by more than 2 or 3%. We can also get a quick look at the Dow Jones Industrial Average. Aside from the mega caps that we were just looking at, we're seeing kind of a mix between red and green, and I'll put this on an equal weighted basis. To the upside, we got IBM, that is in number one place in the upper left, that is up 2.04%, followed by Amazon. Then you got United Health, Nvidia, Microsoft, Walmart, Nike, Boeing. Those are all the winners on the top row. To the downside, we got telecommunications giant Verizon, that is leading down 2%, and then also in the red, we got Coca-Cola, Amgen, Procter & Gamble, Merck, so kind of a mix of healthcare and staples companies. Now let's take a switch over to see what our leaders indices are doing. And these are just a collection of ETFs I use to gauge sentiment. And in primary places, IPO, that is an ETF of IPOs. So that's not surprising there, but that is up 2.5%. And we're also seeing software. That is a leader up 1.5%. Let's send it now over to executive editor Brian Sozzi, live at the Goldman Sachs Communacopia and Technology Conference in San Francisco.
Hey, thanks so much, Jared. Yeah, the crowd's starting to pick up here at the Communacopia Conference. I'm here with the really man of the conference, I should say, Jan Hatzius, Goldman Sachs chief economist. Jan, always nice to see you here at this event. I think this is a market trying to figure out what in the world is going on with the U.S. labor market. It is really decelerated. What is going on with the labor market, and how bad could things get?
Clearly, employment growth has decelerated. Right now, we're looking at 29,000 on average new jobs created in the last 3 months. This is a preliminary estimate. We've learned that these numbers can get revised. But I think it's quite clear that employment growth has fallen to levels that are below the longer-term labor supply trends. That's why the unemployment rate has started to edge up. That's why household employment to population ratio has come down. So I think in our baseline, this is a period of weakness with an increase in the unemployment rate or of another couple of tenths maybe, that then starts to recede as we go into 2026, when we have the economy picking up a little bit for a variety of factors. But you have to watch this, because this is a time when there is a risk of a sharper downturn. And as a policymaker, as a Fed official, you're going to be particularly focused at this point on labor market development.
What is your probability that this is a deeper downturn?
Well, we have said probability of recession over the next 12 months of 30%. That's where we are currently. I think that's not too far from the consensus. Last number I saw was somewhere in the 30s. It's come down a little bit because on the GDP growth side, things actually have been a little bit better. And this, it's the passage of time. If something doesn't break for a period of time, then you're more likely to sort of get to the other side. But there's still a risk, and that's why policymakers need to watch it.
Is this economy, could you consider it stall speed?
I think we are close to stall speed. Where exactly we are relative to stall speed is hard to know, but that is the historical regularity, that the unemployment rate either doesn't go up at all or it goes up a lot. And there's not a lot in between. You can sometimes see a few tenths of a percentage point of increase, but usually if it's more than half a percentage point or 3/4 of a percentage point in a short period of time, that is a recession. We're not there yet. The unemployment rate's still low, 4.3%, but it requires vigilance.
You mentioned that the economy could be reaccelerating into next year. What are the factors that would do that?
Yeah, so just to be clear, in the remainder of 2025, we still think it's going to be relatively slow. But once you get into next year, I'm expecting the Fed to cut rates. I think they're going to deliver 3 cuts in September, October, December, and then probably another couple of cuts next year.
Or 3, 4 or 5? I've heard as much as 6 or 7.
Well, we have 5 cuts through the middle of next year, so 125 basis points from here. That is a supportive factor. Fiscal policy is going to turn expansionary in the first half of next year. This year, fiscal policy, if you include tariffs in fiscal policy, is a drag on growth. Next year, fiscal policy is going to be a boost to growth. So that's probably going to help. And then it's just the passage of time. I mean, if we manage to get through this slower period, then I think the risks that weakness feeds on itself diminish.
Clearly, of course, rate cuts now coming into focus, markets trading up on that. As the chief economist at Goldman Sachs, how worried are you about Fed independence, or is this just a talking point?
Well, I think independence of monetary policy is very, very important, and we have done significant research on this. There's a lot of academic evidence that independent monetary policy over time delivers lower inflation rates. And you can see that in a variety of ways. You can just look at more independent central banks versus less independent central banks, what average inflation looks like in those 2 cases. You can look at changes in the legal status of central banks and monetary policy committees. And if it moves in the direction of less independence, you do end up with more inflation and vice versa. So it's certainly something that we're focused on.
The Fed has challenged the Trump administration has challenged Fed independence. It has also challenged the quality of economic data. As someone that crunches numbers and has been doing this for decades, do you still believe in the quality of economic data in this country?
Well, I think that historically, U.S. economic data has been really preeminent in terms of quality, and that's particularly true for the labor market numbers. where there is a lot of very timely information. You get weekly data on jobless claims, 5 days after the week to which the release refers. You get very comprehensive establishment survey and household survey data just shortly after the month during which the event occurred. So all of that is not necessarily available in many other countries. Now, it is true that economic data is imperfect. Government data is imperfect. Private data is imperfect. I'm a big fan of averaging lots of different indicators that purport to measure the same thing in order to get a more accurate picture. And there's certainly room for improvement, speeding up benchmark revisions, building new information about new firm creation into the payroll data more quickly. So, but that is going to require resources. And I do think that spending those resources, it has a high payoff because we all benefit from having the most accurate data possible.
So true, and congrats on your award. On crunching some of this economic data, I know you're one of the best in the game. Jan Hatzius, Goldman Sachs Chief Economist. Always nice to see you.
Thank you, Brian.
All right, do stick around. Much more ahead on Yahoo Finance throughout the day.